Hey everyone, welcome back to Corporate Decoder, the place where we unpack the secrets hidden in corporate filings. Today we're diving deep into Duos Technologies Group. Their latest filing is quite the roller coaster, showing a company trying to pivot dramatically while juggling some serious financial tightropes. Let's see if they're riding the wave or getting pulled under. Right off the bat, this is a prospectus. Think of it as a company saying, here's our story and we're trying to sell some more of it. Duos Technologies Group is offering up about 4.7 million shares of their common stock. Now, they aren't actually selling these shares themselves this time around. Instead, it's some existing shareholders, the selling stockholders as they're called, who are looking to cash out. The whole point here is that these selling stockholders got some preferred stock Series E convertible preferred stock, and now they want to convert that into regular common stock, which is what most people buy and sell, and then sell those shares to you, the public. Duos Technologies itself isn't making any money from this particular sale. Now let's get to the juicy part, the numbers. For the year 2024, Duos total revenues were about $7.3 million. That sounds okay, but critically, it's actually a bit lower than the $7.5 million they made in 2023. So while they're bringing in money, it's slightly less than the year before. And here's a big red flag, their gross margin. That's the money left after paying for the cost of making their product or service. It dropped dramatically from $1.3 million in 2023 to just $469,000 in 2024. This means their costs are rising faster than their revenue, eating into their profit potential. And when you look at their operating expenses, things get even tougher. They lost over $11 million in 2024. That's actually an improvement from the nearly $11.5 million they lost in 2023, but still a huge loss. This shows the company is spending a lot more money than it's making just to run the business. On the flip side, their total assets grew significantly from about $12.8 million at the end of 2023 to over $34.9 million by the end of 24. This massive jump is largely due to new investments, particularly the equity investment in Sawgrass Appiah Holdings LLC and the intangible asset they recorded, which is actually a license for digital image data rights. This suggests they're investing heavily in future growth, but it's important to see if these investments translate into actual profits. However, look at their liabilities. They've exploded from about $7.5 million in 2023 to over $32.7 million in 2024. This huge increase in debt and other financial obligations, especially contract liabilities and notes payable to related parties, is a serious concern. It means the company is taking on a lot more debt to fund its operations and growth. Jumping to the first quarter of 2025, things look a bit rosier, at least on the surface. Their total revenues soared to nearly $5 million, a massive jump from just over $1 million in the same period in 2024. This surge is largely thanks to their new energy business, Duos Energy, and an asset management agreement with New RPR Energy. This related party revenue from services and consulting is the star of the show for this quarter, bringing in almost $4 million. This is directly tied to that deal with Fortress Investment Group mentioned earlier. It's a big revenue boost, but remember it's from a related party, so it warrants careful examination. But look at that gross margin for the first quarter of 2025. It jumped to $1.3 million, a huge increase from just $94,000 in the prior year. This is mostly because the revenue from that 5% equity interest in New Appiah's parent company came with no associated costs, meaning it was pure profit margin. That's a great boost, but it's important to remember that's a one-time thing from an equity investment, not necessarily repeatable operational profit. However, their operating expenses also crept up by about 9%, while the sales and marketing costs actually went down. Likely because resources were shifted to support the new energy business, general and administrative costs went up quite a bit, partly due to non-cash stock-based compensation for the executive team. Now let's talk about the risks. The company itself admits its technology is complex, and if they can't manage it well or integrate new solutions smoothly, it could really hurt their income and reputation. They also point out the rapid pace of technology change, meaning they might struggle to keep up and the market for their products might not turn out as they expect. And like many tech companies, their success is tied to how well the overall economy is doing and whether businesses are willing to spend money on new technology. Plus, they've got bigger competitors out there with more resources. Crucially, they highlight the history of losses and they warn that their expansion plans could lead to even more losses and negative cash flow. This is a big one as it means they likely need more funding, which could dilute your ownership if they issue more stock. A major part of their future success, they say, hinges on this big asset management agreement they have with New APR Energy. If that deal doesn't pan out as planned, their projected revenue and potential profitability for 2025 could be significantly impacted. This shows a heavy reliance on this one agreement. Looking at who owns a big chunk of the company, Blycroda LP is a major shareholder, owning 19.99% of the common stock after considering some ownership limitations. They also hold convertible preferred stock, which could give them even more influence if converted. Let's check out the leadership team. Charles Ferry, the CEO, has a background that includes not just business but also significant military experience, even earning a Silver Star. The board seems to believe his leadership qualities are essential for the company's growth. Adrian Goldfarb, the CFO, has been with the company in various capacities for a long time and has a deep history in the technology industry, from his days at IBM and Fujitsu. It's good to see someone with such extensive financial experience at the helm, especially given the company's financial position. Christopher King, the new Chief Operating Officer, also brings a wealth of experience, particularly from the energy sector, and he's even taking on a similar role at that new APR Energy company. This shared leadership between Duos and New APR suggests a strong strategic alignment which could be beneficial for both. Their strategy is quite ambitious. They're not just sticking to their original railcar inspection technology. They're actively expanding into edge data centers, which means processing data closer to where it's generated and into the power generation market. Especially for data centers that need reliable power, this diversification shows a desire to tap into high growth areas. Their goals are clear. Grow revenue significantly by entering these new markets, break even and become profitable in 2025, form strategic partnerships, and basically become a more robust company ready for further growth or even acquisitions. Let's talk about their main operating company, Duos Technologies Inc. It's their original business, focused on technology for the transportation industry, and they'd managed to get 11 patents for their wayside technology, which sounds pretty impressive and gives them a competitive edge in that specific area. Their flagship product, the Railcar Inspection Portal, or RIP, is designed to scan moving rail cars for defects. They've been making big technical strides in 2024, like developing a modular design allowing customers to pick and choose what they need, which makes it more flexible and cost-effective. They're also shifting to a RIP as a service model. One of the key technical advancements involves laser illumination. This is set to improve image quality, make the system more durable, and importantly, reduce hardware costs by about 60-70%. That's a huge potential margin improvement. They're also enhancing their AI-driven self-diagnostics to maximize system uptime time, meaning their own tech helps keep the tech running smoothly. The company's auditors, Salberg and Company, identified a few crucial audit matters. One is their accounting for an equity method investment in Sawgrass APR Holdings LLC. This involves valuing that investment, and the auditors spent significant time reviewing management's analysis and valuation methods, highlighting the complexity and subjectivity involved. Another critical point is their revenue recognition method, especially for technology systems. They use a cost-based approach where they have to estimate costs to finish projects. This involves a lot of judgment, and the auditors were especially focused on ensuring those estimates were reasonable. Lastly, and perhaps most importantly on this critical matters list, is the analysis of their liquidity and whether they can continue as a going concern. Given their history of losses and negative cash flow, the auditors had to meticulously review management's plans for future cash flow and financing. They seem to agree with management's conclusion that they have enough resources and access to capital to keep operating, but it's clearly a closely watched area. In my opinion, Duos Technologies is making some very aggressive strategic moves, trying to diversify beyond their core rail business into the booming data center and power markets. The asset management agreement with New APR is a significant development that could provide much needed revenue. However, the sheer volume of debt they've taken on and the high reliance on this related party agreement are definite warning signs. Their ability to manage complex projects while controlling costs, especially with those rising expenses and shrinking gross margins in certain areas, is a major challenge. While the new leadership and technical innovations like laser illumination sound promising, investors should be cautious. The company is clearly in a growth phase, but it's a phase that comes with considerable financial risk. They need to prove these new ventures can translate into sustainable, profitable operations. Alright, that's our breakdown of Duos Technologies' latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.